Welcome to The Explainer. Today, we're taking the incredibly dry, jargon-heavy world of equity issuance and translating it into what it really is, a fascinating look at corporate control and financial risk. Because think about it, when a company decides to raise capital, they aren't just moving money from point A to point B, they are literally redrawing the blueprint of who holds the power and ultimately who holds the bag. So, here's our game plan for today. We'll be looking at the board's master plan, the anatomy of a share, the underwriting process, common versus preferred stock, and finally, recording the issuance.
All right, Section 1, the board's master plan.
Now, the true anchor of this entire master plan is the capital structure policy. This is the governing document that lays down the law on a company's target debt-to-equity ratio, its acceptable leverage range, and the really strict criteria for when to actually raise new external capital versus just relying on internal cash flow. And listen, this isn't some set-it-and-forget-it binder collecting dust on a shelf. This policy has to be reviewed annually by the board and the CFO. If you're advising on any capital transaction, understanding this policy, that's mandatory reading before you make a single move.
Okay, let's move on to Section 2, anatomy of a share.
First up, we've got authorized shares. This is the absolute hard legal maximum number of shares a company is allowed to issue, and it is strictly hard-coded into the certificate of incorporation. Meaning, if a company hits this ceiling, they can't just magically decide to print more shares on a whim. No way. To raise that ceiling, they absolutely have to go through a formal shareholder vote to amend the certificate first. And this brings us to what I like to call cap table confusion. So you've got authorized at the top, that's your governance ceiling. Then you've got issued shares. That means all the shares ever put into circulation, including the ones the company actually bought back, treasury stock. But here's the real kicker. Outstanding shares. That's issued shares minus treasury stock. You really need to memorize this distinction because outstanding shares dictate your earnings per share and market cap, while issued shares are what you'd use to analyze overall dilution. If you mix these up, you literally change the entire math. It's also super fascinating to look at the shadows on the cap table, basically the shares in reserve. These are authorized but unissued shares, just sitting there, set aside for specific future events. We're talking employee stock option plans, the conversion of convertible notes, or maybe the exercise of outstanding warrants. You gotta watch out for this, because a massive unissued reserve for employee compensation silently dilutes the effective per share value for all the existing holders. Especially in venture-backed startups, this shadow pool can seriously erode your ownership value way before those shares even see the light of day.
Moving right along to Section 3, the underwriting process.
5 to 7%. Take a second to think about that massive number. That is the typical underwriting discount fee paid straight out of the gross proceeds of an initial public offering. So if a company raises $100 million, boom, 5 to 7 million of that just vanishes instantly to pay the investment bankers. Which leads to a massive, massive trap for financial professionals. You must always use net proceeds to record the issuance. Never, ever use gross proceeds. The underwriter's discount directly reduces your cash, right? That money never even hits your bank account. So you absolutely must solely record the net proceeds in your accounting journal entries. Actually, let me reiterate that. Don't try to record the gross amount and then expense the fee later. Just don't do it. Now, buried inside that underwriting agreement are a few other key terms we need to touch on. You've got the offering price, which is pretty straightforward. That's what the public pays. You have the representations and warranties, which are these strict legal statements vouching for the financial accuracy of the company. But honestly, the coolest tool here is the green shoe option. This gives underwriters the right to sell up to 15% more shares than the original offering size. Why? Specifically to stabilize the post-offering stock price if demand goes absolutely crazy. It's just a brilliant mechanism for market control. All right, Section 4, common versus preferred stock. Let's look at the power dynamics. On one side of the ring, we have common stock. This is your baseline ownership. You get the voting power to elect the board, sure, but financially, they hold what we call residual claims. Basically, they get the scraps at the very bottom of the barrel in a liquidation. On the other side, you've got preferred stock. These investors don't just take the baseline. They have heavily negotiated contractual rights, including super strict preferences on dividends and liquidations. Long story short, they get paid first. But hey, regardless of the class, shares typically come with a par value. It's this nominal legal floor, usually a tiny fraction of a penny, like $0.001. That means a million shares are technically worth, what, $100? While this completely lacks any real economic significance in today's market, it is absolutely required for balance sheets. When you record an issuance, that tiny par value goes straight into the common stock account, while every single penny above that nominal floor gets recorded entirely separately as additional paid-in capital. Let's zoom in on the sheer power of participating preferred stock. This works in a two-step hierarchy. Step 1, these stockholders receive their stated preference first, essentially clearing out the top layer of cash. Then, Step 2, unlike non-participating preferred, which just takes that first payout and stops, these guys actually double dip. They continue to share the remaining upside right alongside the common holders. It is an incredibly powerful position to be in.
But wait, preferred rights can also hide massive liabilities, specifically cumulative preferred dividends. Even if the board never officially declares a dividend, these things accrue silently in the background on a calendar basis. And because they absolutely have to be paid out before common shareholders get a single dime, they are secretly eating away at the net income. You have to subtract these undeclared dividends from your net income when you're computing basic earnings per share. Do not forget that.
Then we have the ultimate trump card, redeemable preferred stock. So if a preferred holder has the contractual right to literally force the company to buy back their shares on demand, well, the accounting rules completely change. Since the company might have to cough up cash at the investor's whim, this is legally no longer classified as permanent equity. Instead, it gets parked in this special section on the balance sheet called mezzanine equity, kind of living in the gray area right between total liabilities and permanent stockholders' equity.
Okay, final stretch. Section 5, recording the issuance. Let's boil all this down to a journal entry.
Before we write the actual entry, we have to deal with the costs. We're talking those heavy underwriting discounts we mentioned earlier, plus legal fees, registration fees, the whole shebang. Here's a massive rookie mistake: expensing these on the income statement. Do not do that. Unlike debt issuance, the golden rule here is that these costs are a direct reduction of your additional paid-in capital, or APIC. And that brings us right to the standard US GAAP finish line. Here's how it looks. You simply debit cash for the net proceeds. Remember, we already stripped out the underwriter fees, right? Then you credit your common stock account for that tiny par value multiplied by the shares issued. And finally, you take the massive remainder, the excess of net proceeds over par, and dump it straight into your additional paid-in capital as a credit. That's it. The blueprint is officially formalized on the balance sheet. But, the story doesn't always end perfectly. What happens if the company stumbles and has to issue new shares at a lower price than before, a down round? Well, that is exactly where anti-dilution rights get triggered. The conversion ratio automatically adjusts in the earlier preferred investor's favor to protect their value. You've got to watch out for this because these anti-dilution adjustments completely change the number of common shares issuable upon conversion. And that requires immediate, pretty complex updates to your diluted EPS and your cap table. Which leaves us with this final thought. Founders often raise their initial cash using safe notes, simple agreements for future equity. But remember, these aren't actually equity at issuance. They just kind of sit there waiting. So when those notes finally convert into preferred equity during a priced round, or when anti-dilution protections trigger during a down round, what is the true, hidden cost of raising capital for the original founders? Capital structure isn't just about cash, guys. It's about who really owns the future of the company. Keep that in mind the next time you're staring at a cap table. Thanks so much for joining me on this explainer.